alternative product this week. And Brent Ward, if you're out there, thanks so much for the business, 11,127. So the polls close in 5 hours. If you got more business to put in, that would be great. But again, thank you all very much for your focus, and again, thanks for the business. A couple of quick things before we turn the call over to John and to Dave. At 8 o'clock this morning, immediately following this call, if you have any challenges out there closing the sale, or more importantly, solidifying the sale, you know, it's one thing to write an app, it's another thing to be able to place the app. If you're having challenges with the withdrawals or NTOs and that kind of thing, you know, solidifying the sale may be something you need to learn more about, and there's going to be a great class at 8 o'clock this morning Pacific, so you can dial into that. We're going to certainly do a very, very deep dive this morning with regard to Mutual of Omaha. However, there's another product training at 10 o'clock with our friends from Transamerica. So if you've got time in your schedule and you want to join that call, that's great. But more importantly, right now, this morning, we have a huge opportunity. This is something we've been waiting for a long time. Mutual of Omaha has had a tremendous history with both our former ACSIA group and our former FP group. We have a great relationship with the folks from AIM, have a great relationship from their partner sister company, MutualCare. And it's great. It's really, really great that today is the day that we're really able to roll out for California. And we've been waiting a long time for this, I think, to Todd's point. You know, this is not a tease. This is the real deal. The product is really here. We're really excited to be able to reveal and roll out this new Mutual of Omaha product for you. So it does give you an alternative, you know, product in your portfolio for the state of California. Dave Whalen has put a lot of work into this presentation this morning. I know that John Hennessy is out there as well, and hopefully our training director, Rob Kreider, is out there as well this morning. So at this point, quite frankly, I'm thrilled, and I'm really, really happy to turn the call over to Dave Whalen, who can take us through everything we want to know about the new Mutual of Omaha product. Dave, take it away.
Oh, thanks, Stephen. I appreciate that. And actually, John wanted to mention a few comments here before we get started. So, John, you want to take it for a minute?
Sure. Good morning, everybody. Thanks for getting up so early. Like Steve said, we're really, really excited to finally have this product approved. Todd knows the number of false starts that we've had, and it's taken literally years. I think we've been out of the state now for 2.5 years, so we're really, really excited to get back in there, especially with such a limited playing field down there. Wanted to mention a couple things. Number one, we're going to be doing a series of workshops beginning on the 9th in Sacramento, the 10th in Garden Grove, and the 11th in San Diego. The first round of meetings is going to be a little bit different in that we're bringing Harley Gordon in. I know some of you guys had the opportunity to listen to Harley in Atlanta, but not all of you. And I think Stephen and Rob would agree that he's very, very good. I had never actually heard of him, obviously, all these years, but I thought he was really outstanding at your event in Atlanta, and we're really excited to be able to bring him in to Sacramento, Garden Grove, and San Diego. We're also going to be throughout the state the following week in Walnut Creek, Burlingame, Pasadena, Woodland Hills, and Long Beach, in that order, the week of the 16th. So if you have an interest in joining us, we'd love to have you there. We're also bringing out, for all of the meetings, the new Director of Underwriting at Mutual of Omaha, Alan Gregoire. He also was in Atlanta. Although he didn't get up and speak, I hope some of you got a chance to meet him. I've, in my dealings with him, and just as evidenced by his willingness to be out in the field with us for 2 weeks, that's a huge deal. We don't normally have underwriters that even want to do it, let alone can do it. They tend to be busy people. But I think he's going to be really a change instrument for us. Nothing magic. I think it'll take time, but I do see him as a very field-friendly guy. He really cares about the agents. He's not afraid to get out in front of them. In fact, he really enjoys it. So it'd be a really good opportunity for you guys if you want to join us at these meetings. Also want to make an announcement about Mutual of Omaha's new e-app. This is something we've been trying to get done for about 8 years, and at long last, finally, they have an e-app. Dave and I had a chance to sit through a demo yesterday. They're going to be releasing it on the 19th of March and on a limited basis, and obviously you guys will have access to it. It's pretty slick. They had an e-app in the past that was very clunky. This one has, has a few sort of phase one improvements that could be made, but I think you're going to really love the signature process. It's as easy as it can be. It's really a slick deal. So I wanted to make those announcements. Today we're going to spend some time going through the product in detail, and unlike other webinars, having it unmuted to be able to interact with you guys and hear your questions and answer them. That's the way we want to do it. We're also doing it a little bit differently, using our software developed right here at AIM to actually teach the product. The software is so slick that rather than go through PowerPoint screens and brochures and things like that, I think that software platform itself is a really great training tool. So with that, Dave, I'll just turn it over to you to take it through it.
Thanks, John. I do appreciate that. And thank you again, Stephen. And please feel free to jump in anytime and add anything to what I have to say. And then for all of you out there on the call itself, I'd like to make this as interactive as possible. So if something comes up along the way and you have a question on it, please do not hesitate to interrupt me at all. And currently you should see a little bit of housekeeping on the screen. Basically, John and my contact information over here at American Independent Marketing. John referenced that we're going to be in California for a couple of weeks doing workshops. There is the link, the whyaim.com/seminars that you can go to that will have the schedule of the events starting on the week of the 9th. We are charging a nominal fee of $25 for the Harley events that first week. We are underwriting the majority of the cost to bring Harley out, but we're just asking for a little bit of help. And you'll walk away from that meeting with quite a few takeaways as well, including an 8-hour voucher from Sandy Cruz. And then on March 2nd, that Monday, the software for California, or basically an update to the Mutual of Omaha quote software, will be available to download. And to access that software, you go to whyaim.com/software, and you'll be clicking on the MutualCare Solutions link to download the updated version to have full access. And it should be also up on that very same day on StratDecision, your standalone quote software you use on a day-by-day basis. And if you're looking for material as of March 2nd, the California material will be up on your site that we built for you. If you go to aimforltc.com/LTCFP or /ACSIA, it brings up a map of the U.S. and you can hover over any state, click on that state, and it will bring up the Mutual writing kit complete with brochures, the new agent HIPAA form, and then if it's approved in that state, right below that will be the GTL Critical Care App Pack for the 36 states where that's running.
Can you take them there? Maybe Stephen, you can answer this. Are you aware of that site? I know some people aren't, where you can download the forms.
I'm aware of it. We could certainly
it's been a while.
Get out there to everybody. It's been a while. Yeah.
And also, will you also put the third-party HIPAA? Are you talking about the regular HIPAA or a third-party release?
No, there's a new HIPAA. There's a new HIPAA form just for the agent, so that you can have an open conversation with underwriting, like when you start getting into those issues as far as a decline for undisclosed health.
Right. Thank you.
If you have that HIPAA form on file, the underwriter can have a free and easy conversation with you. Okay, so here's the site. I just went to it's aimforltc.com/LTCFP or ACSIA. It brings up a map of the U.S., and as you move your mouse around across the various states, they kind of get all wavy and stuff. But if you go, I'll go to Oregon, for example, and once you click on a state, it's being a little bit slow. It'll bring up the application itself for Mutual. Let me just get this off my screen. The brochure, the product portfolio.
Yeah, all the forms are out here, so
Yes.
just want to make sure you're aware.
Yep. Is this for downloading or is this for ordering?
Downloading.
And then if you want to order hard forms?
Give us a call.
Okay.
We have all the materials here. Either give us a call or give Golden Care a call if you're working in one of their states.
Scroll down, David.
I'm sorry, are these fillable PDFs or not?
The Mutual product is. The GTL product is not.
Yeah.
So with the e-app coming out, will that be different than the fillable PDF then?
Yeah.
Yes. Yeah,
Okay.
you'll access it right on Mutual of Omaha's website. We'll do a webinar for you folks on that when we get a little bit closer to show you the process, but it's done on Mutual of Omaha's website itself. So if you've never been on Mutual's website, you'll need to establish a login ID and password for mutualofomaha.com.
But that GTL is not coming to California now, right?
No, it's not. It's not.
Okay, I'm sorry. I got confused by that statement.
Yeah, just Mutual.
We're in Oregon here.
And in Oregon, for example, GTL does have an e-app as well on their website, the GTLIC.com website. They do have an e-app up there that you can use for their critical care product as well, along with the quoting tool as well. So that gives you a feel for what this can do for you. So again, it's just a very simple, and if GTL is not approved in your state, obviously it's not going to present it to you on that map. And right now, you can see California is kind of dry land. Well, we're looking forward to making that a darker blue here on the 2nd of March. So. All right, so are we ready, John?
Yep.
Okay. Here we go. It's kind of nice to see that name in a box. It's been a while since we've had California up anywhere. Since July of 2012, I think when the company pulled out of California. Again, the resounding message that we always have for you folks out there is that you can't have a stronger partner than Mutual of Omaha. All of their focus is inward on the policyholders because they do own the company as opposed to outward on to shareholders. They have the ability to do long-range planning as opposed to quarter by quarter, as you've seen the last half of last year with Genworth as an example. So it's a strong, stable, secure. We have brochures that state that very same thing available for your use if you want. It talks about the financial viability of Mutual of Omaha. And those are readily available to ship down to you whenever you need. So please do not ever hesitate to give us a call to order any materials.
Dave, can you make that larger?
I'll try.
And Dave, when we're done, will you email that contact sheet out? Or just Stephen?
Yeah, it'll be part of the recorded. It'll be part of the recorded webinar.
I don't know what that means. Can you just email me that form? I just need that form with your names and numbers again.
Consider it done, Todd.
Thank you.
I'm sorry, I can't make the numbers bigger. Are they too small for everybody to see?
They're fine for me, so I'm not,
okay.
not sure what.
All right, so this product in California is 99.9% identical to the product running elsewhere in the country. There's just a couple of minor differences. So you do have the Partner One Insured discount, where some carriers have done away with that. If you do, I would encourage you to download the standalone software. You can use StratDecision to kind of position the Mutual overall, but you have a lot more flexibility with the standalone software that we built for Mutual of Omaha to dial that premium into a tolerance that your clients can stand. I know there's a limitation when you're quoting custom on StratDecision to the pools of money being in $25,000 increments, whereas on the standalone software you can dial it down actually to $500 increments if necessary. So just keep that in mind as we go forward. It is gender distinct rates as it is elsewhere in the country. So you got to make sure you have your buttons in the right spot. You can quote male-male. You can reverse it and quote female-male or female-female as a combination if you're working with domestic partners. So, ages are simple to input by just using the chart and or typing in their actual birth date. Keep in mind, if you didn't already know it, that Mutual of Omaha will automatically go back 30 calendar days from the date of an application to save age. So when you input, yes.
Can you just go back for a second on the, because we go through this in California a lot, and I think the other states as well with the carriers, on the same-sex issue, do they have to be married or registered, or can they just be living together for X amount of years in a cohabitive relationship like Genworth and
living in a committed financial relationship for the last
2 years? They do not have to be married or registered. And is that like documented in the app somewhere?
It will be right on the section of the app where you're plugging in the details for applying for that spousal discount.
Thank you.
You're welcome.
Is it a minimum 3-year?
Yes.
Thanks.
And the company's taken the client's word for it because they're signing the application. Did that help there?
Mm-hmm.
Okay. All right, so when you input a birth date versus inputting an age, and if the day you're quoting it is within 30 days of their birthday, the software will automatically save their age last birthday. So keep that in mind as well.
I'm sorry, somebody has to mute, guys. We're getting.
I know, I'm getting a lot of feedback. Somebody has me on a speakerphone.
Why don't we just all mute unless we're talking? Mute your phones, maybe.
You can dial *6. That should mute your phone. And then you can dial *6 to unmute yourself to ask a question. All right, there are 4 underwriting classes with Mutual of Omaha. Preferred being a 15% discount off standard. We normally recommend that you quote select at best. If your client does qualify for preferred rates, they will automatically get it during the underwriting process. For clients that are under the age of 65, they have to have had a complete physical with a complete metabolic panel blood work done within the last 2 years to get preferred. So if you're working with a client that hasn't had a physical, but you don't want to tell them to go get a physical prior to applying because they might not get preferred for another reason, let them go through the underwriting process. And if the reason they're being issued select versus preferred is that they need to have a physical with blood work, you've got a 60-day window from that date for that client to go get a physical with blood work and get the results back into underwriting, and they will reconsider and potentially offer your client a preferred rate. So keep that in mind.
So you're not doing full paramed exams on everyone?
No, we're not doing parameds at all.
Thank you.
Okay, they do phone interviews only for under age 65, which could evolve into a cognitive phone interview depending upon how the client answers questions. 65 and older is a face-to-face interview with the nurse at the home. It's not a paramed. Just height, weight is taken, and they go through the full cognitive screen there as well. The very first health question in the section of questions on the application that are, if you answer yes, do not pass go, is if you're 65 years old or older and have not had a physical within the last 2 years with blood work, you cannot even apply for coverage with Mutual. So you have to have had a physical 65 years old or older to move forward. Monthly benefits. California is going to be a rule program in here. The minimum for California is going to be $3,000 a month as opposed to going down to $50 a day. That rule will be in here when the software launches, and the minimum on the policy limit is going to be $75,000 as opposed to elsewhere in the country where you can go down to $50. But again, the software,
why is that?
It was just a requirement that came back from the state, raising the minimum from $50 a day to $100 a day.
It's interesting if it's not partnership, why they're doing that.
Yeah, we always wonder what the Republicans.
Because the other carriers all have lower options.
Not sure. We can check into that for you, Todd, and let you know for sure, but that's the feedback we received from the home office. You have a plethora of elimination periods to select from.
If the minimum is $3,000, that 75,000 is 25 months. So the minimum for a long-term care is 2 years, 24 months. So,
Right. But sometimes you have, for couples discount, someone may already have another policy. You just want to slap on $50 a day to give them the extra couples discount, and we have flexibility to do that when you can go to $1,500 a month even with a 24 months.
I think what happened here is the state came back saying the minimum policy limit you can go in California is $75,000, and given that it has to be at least a 2-year plan length, that's where they came up with the $3,000, as opposed to elsewhere where you can actually go down to $50,000 on the policy limit, which would allow you to go down to $1,500 a month.
Yeah, that's odd. I thought it might be the other way around, but
yeah. With the elimination periods anywhere from a 0 day for the whole policy up to a 1 year, you can add a rider that will waive the elimination period for home health care. This is a pure calendar day elimination. So if you do have the waiver of the home care elimination period rider on your policy and you start off your claim at home, 90 days later, you've satisfied the elimination period for the entire policy. And then the inflation.
That's an improvement, right, over the old one? Didn't we have to, was it you guys where we had to go to, if you got through it at home, you had to then still do it in the facility? I forget.
No, it's always been this way with Mutual.
Okay. All right, good.
Yeah, it's one of the strengths of the policy. A lot of flexibility in the inflation, anywhere from 1% all the way up to 5%. And if you buy anything less than 5%, it comes with a built-in buy-up feature. And what that means is every year on the policy anniversary, if the policyholder doesn't think that their current number is high enough, they can bump that number up or back with no additional underwriting. If they do bump it up, the incremental difference is added at their now attained age.
How many times can they say no?
As many times as they wish for either the first 20 years of owning the policy or age 75, whichever occurs first.
Even
no limit.
That's great.
I want to say a couple things about this because we had some influence on this. These are basically our ideas. And with the increased pressure on rates going up and up and up, something has to give, and there's a whole lot of premium, as you guys know, in that inflation option. So previously, we were early inventors of things like the 4% option and the 3% option. When we looked at what 1 point of inflation is, it's huge, and we decided that it's so big in terms of how much actual dollar impact it has on rates that we decided to go to the quarter-point increment. And a quarter-point increment is about what is it, Dave? 6 or I can't remember, 6% or 8% in premium. But what I remember is that on an average couple, it's about $350 in savings on a quarter point. So these are things that are a little bit unconventional, and they take time to take hold. But the idea here is to give you guys a way to dial in the premium, because the one thing that we haven't done as the carriers have raised rates is we haven't changed what people can afford. All we've done is increase the cost of their insurance. And if you look at average premiums, they're actually not moving up very much. Even though the rates are going up, the average premiums aren't. So what we're trying to do with these inflation options is give you absolutely as much premium flexibility as you possibly can to find that price point where people can afford it. So we've done 3 things. We've lowered the points, as Dave just showed you, all the way down to 1. Dave, I'm jumping in on you a little bit. But we've also introduced that quarter point. And like I said, we're the only ones that have it. And it may feel like you have too much flexibility, but I like to think that we're a whole lot like you guys, that we're long-term care people. The average guy, doesn't like a whole lot of options, but I think for professionals that really work with this business, that you'll find these levers and switches useful. They'll help you get premium dialed in on a case-by-case basis where it needs to be in order to make a sale.
And these will be in StratDecision as well, or these will be more limited in StratDecision?
No, they're in StratDecision as well.
What are the limitations in StratDecision, Dave?
It's a 20. The big one is on the policy limit. You're limited to $25,000 increments. So, like for example, if I wanted to buy a 3-year plan at $4,500 a month, I can just simply type in $162,000 here, and I've got a 3-year plan. You can't do that in StratDecision.
Yeah. Yeah.
So you'll end up having like a 3.2-year plan or a 2.8-year plan. So you can have a lot more flexibility to dial in where you have to dial in.
It forces you to go at either 150,000 or 175,000.
Correct.
Yeah.
Gentlemen, I've run into this over the years, and I like doing Mutual of Omaha in states where it's been available. Can't you prevail upon the big cheeses at StratDecision to fix their gizmo?
We've tried. I've personally tried. I forget the guy's name.
We've had numerous conversations with them over the last 2.5 years about this.
I want to say one thing. There's a woman in Boston who helps run the company, and when they had their first of snowstorms, and I happened to be renewing toward the end of January my annual, it didn't renew. She got on the phone with me. She made it happen. She cared, and I can get you her name if you wish.
Is it Beverly?
Beverly.
I believe so.
Beverly Blacks, yeah.
Yeah, we've known Beverly forever.
I'm blanking on the other guy's name.
Well, you can move it
Bosch
along.
is the tech guy, but then there's the big boss. I forget it.
All right, okay.
Hey, Rob Kreider just joined the call. Rob, if you enter your audio PIN, that will allow me to unmute you so you can join in vocally. It's not the *6, but it's that 2 or 3-digit audio PIN.
But we're getting that feedback again.
Yeah, I know.
I'm muting.
Okay, so besides the...
Hold on one second. This is Stephen. Guys, this is like really, really important stuff. So if you've got a mute switch on your phone, this is the day to do it. Please mute your phone so that we can really get this information out. It's really critical. Thanks a lot.
Thanks, Stephen. Okay, besides the points that John just covered, we also have the caps. You can cap the growth anywhere from 10 years to 15, 20, or make it unlimited or lifetime. And if you're working, where I usually bring in the 20-year cap is if you got clients in their mid-60s, that will give them excellent growth until their mid-80s, which is the expected claims age. And whenever you cap a growth, the actuaries kind of relaxed a little bit because they know exactly what their maximum financial exposure is going to be for that client at claim time. So don't discard the caps. And it really does help you dial in a premium that makes more sense for what your clients are looking to achieve. So besides the points, we give you the caps.
Maybe why don't you run through an example, Dave?
To show what the growth is, or
yeah, just to show how whenever you make a change, the premium down below changes on the fly. Just to
I'll tell you, that's the thing I've missed the most about you not being here. I love that. That 20-year cap was I sold it all day long.
You know, it's a funny thing. People don't know about it. In Atlanta, we had the chance to talk to Larry Heinert, and he had just discovered it. And for us, who are trying to communicate the attributes of this product, it drives us crazy, because we keep saying things over and over and over again, and people miss things. It's amazing. That 20-year cap is and Larry said when he discovered it, he goes, that 20-year cap, you guys destroy everybody with that thing. It's a sales saver, that's for sure. If you go up into the upper ages, that 15-year cap will come in handy, even the 10-year cap in certain circumstances.
Also, if you live in the more expensive communities, like up in Washington or in Northern California, you can, even in the 50s, jack them up a little bit where you feel more comfortable with daily rate and, solve to what at age 80, growing at 3%, but maybe you're giving them 5% for 20 years or whatever it is, you can really front load and hit a price, and it's a gold mine.
Yeah, and our kind of saying we have up here is that having one is better than none. If you buy at least 1%, you're in the game, so you can bump it up in the future. Whereas if you select no inflation, you're locked out. You're done unless you want to reapply for a new policy. So 1% does not add that much to a policy. It takes it from, like you see, you're to 1268, and just to put 1% on there.
Yeah.
Is
well,
nothing.
Another one of the things that we
do one with a 10-year cap and increase both the operative effect of the inflation and the number, or just the number.
What did you mean by operative effect?
If you cap it, you're
cap
stuck with the cap.
And go to lifetime.
You can't go. No, you're capped. So if you buy the 10-year cap, you're capped at 10 years forever.
All right, so it's the number you can choose.
It's the number you can play with.
Right.
That's correct.
Are the buy-ups, so you're only offered the buy-up during the 10 years is what you're saying?
Right, every year in your policy
and it's every 3 years?
Every year. No, every year, every policy anniversary.
You can.
It is not offered to you. The policyholder has to be proactive and initiate that. They'll get no communication from the company that, oh, hey, it's your 1-year anniversary. You want to do anything? They will not do that.
And what is, they can only buy up on the rate they chose, or they can buy up what's being offered to them?
No, they can buy up whatever they want to do. So, for example, if they decided to buy 1 1/4, and 3 years from now, or 10 years from now, or 16 years from now, they want to increase it to 1 1/2, or 1 3/4, or 3 1/2, or they can do whatever they want to do. So let's just say 3 years from now they decided they wanted to increase it to 3. They increase it to 3. The year after that, they decide they don't want to do anything. They don't have to. Another year, they want to add another half point, they can add a half point. 5 years later, they want another half point, they add another half point. They can do whatever they want to do, not to just they can't exceed 5 points total.
Yeah, why wouldn't you be sending the letters to try to drive up business? I mean,
well,
or I guess the other thing is for us, that's a new sort of touchstone that we have to put on our calendars.
Here's
They're not
the
going to
thing.
do it automatically. We should probably, at least for me, I would go back and make notes on these people and go back and touch them again.
There's a couple things, a couple thoughts there. One is the idea behind the guaranteed upgrade option is it was intended to make the agent more inclined to sell it and more comfortable selling it. And the way to do that was to basically take the agent off the hook by allowing his customer or her customer to make a new decision later. So rather than put somebody in a box and be accused of not selling enough, what we did is we put this in so that wouldn't happen. That everybody's got an out. If you, we want to make it comfortable for you to sell less now. The reality, Todd, to your question is the company would rather have less inflation. You know what the inflation has done to these carriers and what it's done to us as far as the rates. They like the idea of having them buy less inflation. So that's why they're not, reminding them every year.
I don't like that.
Well, it's a
So
compromise. I understand.
Most people won't do it, but it's nice for them to get the letter so that you, as the agent, don't have to be the one to be looking out for it every year. But
yeah.
I have a question on this going rate increase. You've been going where they can. You've been saying it where they can add more each year, but you also stated they can reduce it. Is that right? Is there any limit on that?
No, it's a downgrade. So, decreasing risk they don't care about.
Okay. Thank you.
And is that priced at their attained age?
Yeah, the increases are at attained age.
What about the decrease?
Original age.
Yeah.
Thank you.
Any policy downgrade is always done at original age.
Yeah.
Right. Okay.
We basically have to instruct our insureds to be proactive and to watch this on a yearly basis on their own if we're not reminding them.
True statement.
In most cases, people are buying what they can afford. You guys know this. So they're not buying 2% now with the plan to increase it to 4%. But the option's there, That allows you to make, to place that 2% sale.
I would venture to say to play with the numbers, and if you can give them some sort of a cap with more aggressive growth that does it automatically and hits the same price, you'll have less problems in the end when they go, later in life. Because then the kids aren't going to remember, and all of a sudden,
The nice thing about this entire program, though, is that you have so much flexibility with so many different things: the monthly benefit, the policy limit, the elimination period, the inflation, everything. It's just amazing how you can adjust the benefits here.
And can you just tell me say again what the couples discounts are for the one insured?
It's 30% for married or partners both insured, and it's a 15% for married one insured.
Thank you. Or couples one insured, yeah.
Yeah.
30 and 15.
Okay, out of the factory, all benefits are equal. So your nursing home, your residential care facility, and your home health care are all equal. You can reduce these benefits. You can reduce the residential care to 75% only. Outside of California, you can reduce it to 75 or 50, but California only approved reducing it by 75%. Home health care can be reduced from being equal to a nursing home to 75 or 50, but caution you that if you do reduce the home health care benefit, you are having a direct impact on the cash benefit, because the cash benefit is 40% of whatever you have for your monthly home health care benefit. So if you reduce the home health care benefit, you're having a negative impact on the cash benefit. And again, this is another area in which we think is kind of a separating factor from Mutual of Omaha. We're firm believers that all long-term care policies should have some kind of a cash component. We have no idea what long-term care services are going to look like 5 years from now, let alone 10 or 20 years from now. And it wasn't that long ago that assisted living was a twinkle in somebody's eye. So if you have language, or if you have a benefit in a contract that will allow this policy to evolve over time, we think that is just paramount. In fact, in a recent webinar that John did, there's this whole new concept called granny pods, where it's actually a portable home you can drop in your backyard. It's self-contained with monitoring equipment, cameras, defibrillator, all the links to the doctor's office, a way in which you can one way to keep mom and dad home for a little bit longer as opposed to having to move them into an assisted living facility. Those aren't covered in the black and white of a contract, but the cash benefit would go a long way to help pay for that. Christine's having a hard time getting on audio. Christine, if you dial that audio PIN number on your screen, you should be able to get on the audio portion of the webinar as well. Question, Todd?
Yeah, the cash is you do or do not have to get through the elimination period first.
There's no elimination period with the cash benefit. So if you do go on claim and you request to check that very first month, that's fine. But keep in mind that the cash benefit is in lieu of any other policy benefits, including satisfying your elimination period. So you'll still be on the hook to satisfy the elim if you pop off the cash and go back on regular traditional reimbursement.
You're better off getting the elimination period over with, basically.
Well, if you buy here's a logical progression. If you buy the waiver and you start off in cash and you are at home and you finally figure out the agency you want to use and you pop back onto traditional benefits, you're immediately on policy benefits. And oh, by the way, now you're starting to tick off the days to satisfy the elimination period for the rest of the policy.
It's important.
Oh, go ahead. Another question? Okay. All right, spousal benefits, shared care, same as elsewhere, however, which is there's a 1-year holdback. So there's actually 2 benefits to this rider. The first being if one of a couple goes on claim and exhausts his or her policy benefits, they can dip into their spouse's or partner's policy. The rule is they have to leave their spouse with at least 12 months worth of coverage. The second benefit to this rider is if the husband were to pass away and never touch his policy, whatever is remaining in his pool transfers to his surviving spouse with no impact on her premium. In fact, the cost of the shared care rider comes off her policy and her premium actually goes down. And if there's inflation involved in the policy, the whole new bucket, bigger bucket, will continue to grow with inflation over time.
And that's automatic. She doesn't have to reduce it by calling in.
No, automatic.
The benefit shared care will go away when he
once the company is notified that the spouse has passed away. Survivorship. It's a 10-year survivorship with Mutual of Omaha. Unique to Mutual, though, is that you could have been on claim in the first 10 years. You just have to be alive for the first 10 years. So the husband could claim at year 8, pass away at year 11. His spouse's policy is now paid up.
Wait, repeat that, please.
Sure. To trigger this benefit, one of a married couple has to die. It's exactly that. It's a survivorship thing. But with Mutual of Omaha, you do not have to be claim-free and alive for the first 10 years. You just have to be alive for the first 10 years before this benefit kicks in.
Thank you.
Okay. So the spouse could claim at year 8, pass away at year 11, and the surviving spouse's policy is paid up. Spouse waiver of premium is just that. If one goes on claim and stops paying premium, they both stop paying premium. And when that claim ends, the spouse will start paying premium again.
Dave, can I mention with that too? On that spouse waiver of premium, it is such an inexpensive add-on.
It's 2%.
Oh, it's extremely low. Yeah.
Yep.
When they see it and understand it, most every couple will put it on. It seems.
Now, keep in mind if you look at a sample policy and read that rider, there's a 10-year wait before that joint waiver kicks in the policy. Just want to make sure you're going to this with all your eyes wide open. Security benefit. This is a unique one to Mutual of Omaha. No other carrier comes close to offering this. This is a benefit that could be looked at when you're working with a couple and you know that one of them is clearly uninsurable when they tell you they have MS, or they go through the regular underwriting process together and one of them is declined for a reason that's not going to be insurable anywhere else. It's a rider you can put on the healthy person's policy that could potentially benefit the uninsurable down the road. And it's a benefit that belongs to the person who is eligible to get a policy issued. It's basically a 60% indemnity rider that you're adding to that person's policy. When that person ends up triggering a claim and they're getting reimbursed for their expenses, the company is going to write them a check for an additional 60% above and beyond whatever they were reimbursed for that month. The thinking being that that additional money could be used to help offset the cost of care for the uninsurable spouse. If the uninsurable spouse needed that money sooner than the healthy one claiming, that's too bad. They cannot get access to that additional money until the person who owns the policy initiates a claim. But it has helped quite a few of you folks out there in the past conserve a sale or two when you work with somebody who is uninsurable and they basically tell you that they'll be perfectly willing to buy from you as long as you can find some kind of coverage for both of them. Very unique to Mutual of Omaha.
And that's indemnity, correct? Is that what you said?
It's indemnity. It's a check. 60% of whatever they are reimbursed for that month. So it's not 60% of this number. It's whatever number is that they turn in to be reimbursed for that month for services they received.
So it can't be along with the cash for the insured. If the insured's taking cash, it wouldn't be kick in yet.
That's true. They have to be on traditional reimbursement to have that benefit.
And if I remember, it was really expensive. Is it still really expensive?
Yeah, it's about the total premium for that policy would be pretty close to what the couple would have committed to as a couple if they were both issued.
Got it. Okay.
It adds exactly 60% to the premium.
That's what I remember. It's 60% of the premium.
It's a lot. Yeah. I remember that.
Can you hear me? This is Rob Kreider.
Yeah, Rob.
One of the things I liked about this was that if you said it didn't cover the uninsured spouse, and they then would have to be spending their own money for that uninsured spouse, so they're running their assets down. But down the road, when the other person has health issues, and most of us know they're going to have issues, that would reimburse what you've taken out of that savings. So if the uninsured spouse probably gets sick first or has problems first, there's still a way to reimburse the savings and use that money.
Thanks, Rob.
I hope that made sense.
Yep, for sure.
Dave?
Yes.
I'd like to clarify what you said on the spouse waiver of premium. Because it's been my understanding that at any time, regardless of how long the policy's been enforced, the premium would be waived for both, with this exception. And that is if your premium increased because you purchased additional coverage after the policy was issued. I'm reading from the brochure now. It says that that portion of your premium will not be waived until the increase has been in effect for 10 years. But it's my understanding that at any time there's a need for care, early on or later on, even before the 10 years, that the premium would be waived on both.
Okay, who am I speaking with?
This is Jess.
Jess, okay. Jess, yeah. I'm going to pull a sample contract for California.
Unless it's different in California versus the other states.
It should be the same. If you actually have a sample policy, that would be the best way to look at the language on the rider itself. Okay.
I have one question, Dave.
Yes.
This is Bruce. If a couple has a spousal discount and one of them die, is the price waived on the survivor by 15%? Or do they have 30% for life?
Oh, they'll have 30% for life. The company will never take a discount away.
Okay, thank you.
All right, there are 3 flavors of return of premium available on this policy. You have your death, if death occurs prior to age 65, pretty inexpensive. And obviously for any of these riders, you have to be under age 65 to buy these riders. So you have a death prior to age 65. You have a death at any age, and they're all minus claims. Then you have a unique one here. It's called 3 times MMB. Well, what the heck is that? That means basically it's going to return 3 times your monthly benefit that you selected when you initially applied. So in this example here, it'll be 3 times 4,500 would be 13,500. Death at any age, the company's going to write your beneficiary or your estate a check for $13,500 minus any claims they may have paid out for you. So the first two return of premium riders are pretty inexpensive, the last one being pretty spendy. And there are additional discounts to be had with Mutual. If you have set up an association with the company, there's an additional 5% discount to be had there. If you wanted to write a policy on yourself and or your spouse, there's an additional 5% discount there. And then there's kind of a unique program Mutual has. It's called the Common Employer Group discount. Mutual is not in the worksite business. They pulled out in the summer of 2012. And the one reason why they're still not back in is because they do have gender distinct rates, and you cannot have gender distinct rates in the worksite. However, if you do come across 5 employees that work for a common or a single employer that want to apply for coverage all at the same time, they can do so and get an additional 5% discount. There is no list bill because the employer cannot be involved at all. They'll all be direct billed. And then once you have that common employer group set up, additional employees can apply with that discount at any point in time in the future. Again, it's not a list bill, it's not worksite, but it's another way where you could potentially get an additional discount with Mutual of Omaha. And with Mutual, there's no cap on the discounts that you can achieve or get on your policy. So you can be married, both applying, getting the 30% discount. You can get another 15% discount if you qualify for preferred, and another 5% discount on top of that if you are a member of a qualified association. They're multiplicative, they're not additive, so it's not 30 plus 15 plus 5. You take the 30% discount, and then you take the 15% discount off that premium, and then reduce that premium by another 5%. So they're multiplicative, not additive. That's the product. Now, a couple of things that are not going to be in California that are elsewhere outside of California. The professional home health care rider that doubles your daily benefit if you have a nurse or a therapist coming into your home with that 365-day limit to it, that is not approved in California. And also, in the language of the contract, there is no alternate plan of care in the California policy. So you have to rely on the cash benefit to do anything outside the black and white of the contract.
There's no secure in California?
No, John, not yet. I mean, they're anticipating having it ready to roll by the 2nd of March. They're just waiting for final approval on the brochure.
Yeah.
Okay.
It'll be there.
What does that mean?
Well, the secure
30% cash, right?
It's 30% cash, and it doesn't have most of that inflation flexibility that we talked about. Doesn't have the guaranteed upgrade option that we spoke about.
And why would you want those?
Why would you want those?
That's a very good question. Thank you for feeding us that. We don't. We think you should stay in the custom sandbox because you'll have the richer cash benefit, the greater flexibility in the inflation options, along with that built-in buy feature. You're limited here. You can't get less than a 90-day elimination period on the secure product. And you only have one option if you're looking at return of premium, just the 3 times MMB. And you only have access to shared care and the spouse security. You don't have access to joint waiver or survivorship. It's a dummy-down policy for people that only touch long-term care, say 1 or 2 times a year, that want to see something very simple, as opposed to the sophisticated people like yourselves. We think you want to spend most of your time in the custom.
We're starting to run out of time, Dave. Maybe if you could real quickly hit maybe hit the Pick Max and the Set Target Premium buttons and
sure.
Show them how that works.
Okay. We dialed a couple of sexy little tools in here for you. Pick Max, it brings up a grid showing the monthly cash benefit across the top, the monthly benefit from $1,500, and that will be changed up to the $10,000 max. The pools of money going up to $500,000. You can just grab this blue box, and just drag it anywhere in the screen. These are all legal configurations. It will not let you go outside the boundaries as far as trying to put together an illegal configuration. The rule with Mutual is a policy has to be at least 2 years in length, and it cannot exceed 8 years in length.
So talk through the numbers right, Dave.
Here's your policy limit. It will show you This is your monthly cash benefit. This is your maximum monthly benefit. This will tell you how many years the cash benefit will pay out. This will tell you how many years the policy will pay out if you're maxing out the monthly benefit, and the respective premiums based upon the age of the client you input into the software.
So this is a real easy way to play with any configuration you want and see what it's going to cost.
So you get immediate feedback right here in the premium by doing this. So you can actually let your client play with this if you wanted to. Just turn your laptop around and let them just start scrolling around. So obviously this is making identical benefits for both. If they're not buying shared care, they certainly do not have to buy identical benefits.
Is there an age group that's kind of a sweet spot for you folks, or not?
No. If you were to compare the rates on this product versus the Assured Solutions Gold that's still running in Hawaii, Montana, and New York, male rates age 45 and older on the new product are actually a little bit less than they were on the Assured Solutions Gold. Obviously, the female rate got impacted more. Married couples 65 years and older are actually a little bit less expensive, start to become less expensive on the new product versus the Assured Solutions Gold.
Dave,
you want to compare those two.
We're running up against the clock. I know you guys have other things to do today. We could spend a lot of time with you.
What would here in California?
Say that again?
What's the first day we can actually quote?
The 2nd.
Monday, March 2nd.
Thank you.
Yeah. We appreciate you guys joining us today. We hope you like what you've seen. We're really looking forward to working with you folks down in California again. Hope you can attend one of our workshops. And
if you have any additional questions that we didn't address for you, feel free to drop either myself or John Hennessy an email. Our addresses are right here on the screen right now.
Okay. Let's turn it back over to Steve. I know he's got something to say.
First of all, really great questions, everybody. It really shows you guys are obviously very engaged in the business, and certainly appreciated all the editorial commentary so that you guys really know your stuff. First of all, let's really thank Dave and John for doing all the heavy lifting and getting this product approved in California. It provides us obviously with another solution here, which is very important. You know, as we move forward, as Dave and John said, if you have questions for them, feel free to reach out to them. Certainly, Rob Kreider, our training director, who happens to live here in California, is also very, very familiar with the product. So if you're looking for sweet spots, if you're looking for ways to sell or how to position this product, that will be the next step in our process. But appreciate all of you coming out this morning. I know that we started a half an hour early. I know we focused on California today, although I'm thrilled that we have a variety of you who are not in California who chose to be on the call to expand your product knowledge as well. So we're coming up on a hard stop here at 8 o'clock. We're going to the advanced agent training. Thanks, everybody, for being out there. A special big thank you to John and Dave for being